All right, so let's kind of pivot and move on to low volatility. So low volatility is basically stocks that exhibit low volatility are stocks that have less volatility than the overall market. And there's different ways that we can uncover stocks with less volatility. Do you want to break down at least two of the more standard ways how you can uncover or at least measure the volatility of stocks?
Yeah, when we build our factor report for Validea, we looked at two different things for low volatility. One is we looked at standard deviation, so stocks with a low standard deviation or lower volatility. That's one way to define low volatility. The other way is beta. And the difference between the two is beta takes into account how the particular stock moves in comparison to the market. So standard deviation looks at it on its own. And so if a stock is very volatile, then it's very volatile. But from a beta perspective, a stock could actually be more volatile than the market, but could actually be lower risk because it tends to zig when the market's zagging. And so those are sort of two different ways to look at it. One is a standalone way, and one is more in conjunction with a portfolio that already holds the market. And either one of them can work. We put both in our factor screener, but either one of them can be a good way to define low volatility.
I sort of feel like this flips that whole risk and return thing in finance upside down. I mean, typically we've been, educated and trained to think that the higher risk, the higher the potential return. But in this case, with low volatility stocks, you actually get basically market-like or maybe even higher returns in the market with less volatility. So it really does, in terms of the risk-based explanation about why a factor works, it just doesn't really intuitively make that much sense.
It's a tougher one to it's even tougher than quality to try to explain this. Because if you go back to our principles from the beginning, are you taking extra risk by investing in low volatility? By definition, you are not. So that you really can't come up with a risk-based explanation. So now we need a behavioral-based explanation. And the most common one is that many investors don't have access to leverage. And so in order to add risk to their portfolio, investors that don't have access to leverage will buy these higher beta stocks to try to boost their returns. And they then will overprice those high beta stocks. And so they're effectively underpricing these lower volatile stocks, even though they're less risky. So that's the best explanation. And that's a reasonable explanation. But again, when you look at it relative to value momentum, it's a little bit tougher of an explanation to follow than the behavioral explanations for those.
Yeah. Before we jumped on today, I pulled out O'Shaughnessy's fourth edition of What Works on Wall Street. And in chapter, I think 24, he looks at all of the sector performance from, I think it was, let me just see here, from 1967 to 2009. So he basically looks at both the return of the sector along with the standard deviation of the sector. And what's interesting in this is that consumer staples are the best performing sector over that period of time with what is effectively the second least amount of volatility, just behind utilities, basically. So, I mean, I think one of the things that sort of tends to creep up in these low volatility strategies is you have these, maybe an overweight in consumer staples or those types of stocks that tend to have, much more stable businesses that can't be disrupted as easily. Like they give the example in here that, very few companies might be trying to enter Coca-Cola's market and try to, knock down the moat around Coca-Cola, where technology companies are different. You have a lot of innovation and disruption. So I do think, to some extent, some of these sector characteristics sort of show up in here, and that may also be one of the reasons why you see over time sort of low volatility doing better. It was just a thought that jumped out at me.
Yeah, and you also touched on there's definitely some overlap between low volatility and quality. I mean, if you have a company that's a compounder that's slowly growing its earnings over time, I mean, by that stock is likely to be less volatile than the market, and so you get some overlap with some of the other factors. And another interesting thing, I was listening to an interview, or I was reading an interview with Wes Gray from Robeco that he did this week, and he also talked about how low volatility may be a function of combining cheap stocks with quality. And so his quote was, "I believe that a cheap quality portfolio will act similarly to a low vol beta portfolio most of the time. So setting aside minutia arguments, I think it is probably close to 6 of one, half a dozen of the other. However, I fundamentally believe in the risk behavior arguments underlying value over the arguments underlying low volatility." And so what he's getting at there is maybe low volatility, maybe there's some other things explaining why low volatility works. Maybe it is a blend of quality and value that works. And Larry Swedrow's talked about this a little bit too. He's talked about how if you look at the excess return of low volatility over the long term, the vast majority of that excess return comes when it was cheap. So a lot of that excess return in low volatility is coming at a time where low volatility and value sort of came together. So, that could be an explanation as well.